Dear friends, good afternoon and welcome to the special episode of ETBFSI.com, which is FinNext. Nothing but what's next for the Fintechs is what we are going to discuss in this particular show. We are running this special series fortnightly, and this is the third episode where we are going to discuss what's next for Fintechs. The basic idea behind this series is as most of the fintechs are suffering from funding winter, regulatory challenges, and the future looks blur for many of them. Obviously, the seed funding rounds are still happening. Couple of fintech investors are still saying there is a spring nearby, but the reality is majority of the fintechs are still unable to raise funds, and the question is what's next for them. So, in this particular series called FinNext, we are trying to demystify what is it that the fintechs are doing, what is it that they are looking forward to, and what is it that may happen specifically into the fintech industry. We are also going to have a big show called FinNext in Bangalore next month, and we are going to discuss what is next for fintechs at large event in Bangalore on 15th of January. Do join us there as well. But today in this session, which is going to be for an hour, we have four speakers with us, and let me introduce them to all of you. My first speaker for this panel discussion is Mr. Anand Bajaj, founder, MD, and CEO Pay Nearby. Anand, glad to have you.
Thank you so much, Amol. Glad to interact with you once again.
Thank
Thank
you.
you for calling
Pleasure.
us.
Yeah, thank you. Thank you. Pleasure. My next speaker is Mr. Vinay Matthew, co-founder and CEO of Faircent. Vinay, glad to have you.
Thanks, Amol. Thanks for having me again. Thanks a lot.
Thank you. My next speaker is Mr. Subramaniam SV, co-founder and CEO of Fisdom. Subramaniam, glad to have you.
Hey, thanks, Amol. Glad to be here.
Thank you. Thank you so much. I will also have Guj Dupal Singh, CEO, tied in very soon joining us. But let's begin this particular show. And gentlemen, thanks for being part of this particular series. As we see, the funding winter is kind of shivering to a lot of fintechs, though we are in a summer and it's 38 degree, 26 degree, and 36 degree and 40 degrees in many other cities. Most of the fintechs are actually going through a bad weather. So let me begin by asking one common question to all of you, and that is, with this background where the funding winter is there, the outlook looks a little bleak, regulatory challenges are there. What next is what you see specifically for fintech, or in a very simple term, what's next for fintechs? And Anand, let me start with you.
Thank you, Amol. I think the story of the camel and the unicorn always played in the startup ecosystem. And we would have heard of how a camel in a winter or a dry area in the desert can survive. I think we have imbibed those ethos, and the weather does not matter to us, because the segment that we serve is mass Bharat, where India and the digital divide created is only insulating us and keeping us aloof and afloat. I would say, and the way forward, I believe, is always the core of a fiber is best when it is stitched together, integrated together, thread by thread, into a larger whole. And a collaboration, if I may say, is the best way forward. And we continue to believe in it, and be it in the agri side, or be it in the e-com side, or in a lending side, the collaborations that we at Pay Nearby have done, we believe we have become a platform of platforms, and multiple partners help us drive this to the mass market. I'll pause here, Amol.
No, sure, Anand. We'll get into specifics a little later, but let me take perspective from the other speakers as well. Vinay, let me come to you.
So I think for us, business is as usual, and we always believed in the model that we were trying to kind of build, which is peer-to-peer lending. The entire scenario of alternative finance would have come about in an economy which is a little tight and which is not a little frivolous, right? So I think from that point of view, alternative finance has really come up. P2P that way is leading the show, and we've seen a lot of conversations happening with a lot of wealth tech firms, wealth management companies, IFAs, wanting to kind of onboard Faircent and redistribute or distribute our products to their set of customers. On this side also, we are seeing a lot of traction from the organizations which are wanting to onboard borrowers on our platform. So as I think Anand pointed out, we are also a Bharat wala story. So we are not seeing much of a challenge in the current business that we're running. What I see is that in the During the COVID time, we saw the lending side completely kind of go up, primarily because this alternative was not really looked at that point in time. The stock market and all was not kind of giving that return that we expected. People wanted an alternative, an asset class to kind of ride on. So I think from that point of view, we believe that the next fintech growth also that we are looking at is also going to be in the alternative. A lot of alternative financial models and a lot of alternative uh, investment models are coming about in the fintech space. But apart from that, I think the what I also feel is what is going to change in the next few years is going to the credit scoring, especially in the lending business. Credit scoring will transform, a whole lot. I
Right.
think virtual fingerprints, iris, and all of this, I think, should come about. Much of data with social media data, which is also going to be picked up, which was not there earlier. People had a choice then. I think those activities, those social media activities will also get picked up. IP analysis also is one area I think people are going to work on. So we are seeing all those happen in our ecosystem as well. And to me, I think the earlier models like buy now pay later, all of that is going to remain. It's just that we're going to come in better and a reformed avatar, and there will be an embedded finance rise which will happen, and all of us are seeing that. So that will continue. So all of that will continue, I think. But for me, I think from an alternative space, I think I'm very bullish about it.
Okay, sure. Uh, I think Gurjot also has joined. Gurjot, good to have you here. Thanks for joining. Yeah. So let me come to Subbu and then I will come to you, Gurjot. Good, Subbu, can I have your opening remarks in terms of what's next for fintechs?
Yeah, I think you rightly said. I think funding winter is here, and I think those constraints will probably continue to stay for foreseeable future. I'm not a soothsayer, so I don't know how long this is going to last. So building business models based on investors' money is something that the fintech world has to kind of reconcile. You have to build your own on your own P&L. I think that's one clear takeaway. I think that the second part that we've also seen over the last few months is around regulations and compliance, increased regulatory scrutiny, increased cost of compliance. Wherever there was regulatory arbitrage, regulators have come and kind of taken those away. Regulators are clearly saying, look, pick your businesses, pick your licenses, and operate within the um, boundary lines stipulated for those licenses as opposed to taking care of regulatory arbitrage. So as a result of these two, my view is a lot of challenges will appear for any business that is like thin layer business, wrappers around other businesses. So most companies will try to go towards taking licenses and more being regulated, being present in India. In a funny way, companies will start putting up their regulatory license in their investor decks. Companies will start putting their audit reports on their investor decks so that they come across as like a clean company from a regulatory compliance perspective. Right? I think having a clean regulatory track record will probably become a competitive advantage over a long period of time. And the second one is, focus on revenues and profitability versus uh, scaling up users and other metrics in the hope that revenues will come in the future. As a result, one needs to keep the costs under control, both direct costs as well as overheads. I think those are the sort of big areas that we've all seen in the last year or so, and I expect them to continue, probably even get deeper in the next 12 to 18 months or so.
Mm. Sure, Subbu. Thanks for that note. Gurjot, let me come to you. So the question that I asked to all the panelists is basically what's next for fintechs, given the background of funding winter, regulatory challenges, and bleak business models. So what is your opening view, Gurjot?
Uh, well, I believe this is, the best time for people in fintech who are actually using technology to solve real problems in financial services delivery. Um, and many of us here are the ones who were never, dancing when lots of funding was flowing around because, most of us here are the companies who are trying to solve some real problem. And when you solve real problem, there are unit economics and there are revenues involved. Just to give a perspective of my own organization, right? So for us, funding winter is one piece, but our first market, UK, where we have 10% market share and we are the market leaders in challenger banks focusing on SMEs. That market has also gone through a lot of economic downturn as well. But even through that, our plans have not changed even 1%. We continue to build our teams. We continue to focus on growth for our businesses in the markets that we had committed to. We continue to run regular appraisal cycles. We continue to scale our teams, etc., and scale our businesses. Now, having said that, right, what enables that, and what will change in this funding winter? I think what will change is that the investors are looking at real unit economics, real sustainability of business, and not just traction will fly. A lot of fintechs were actually going after the segments which are already served. So for example, if somebody is already having 1 or 2 credit cards, what is the point of offering a challenger card to that person? A person who's already paying online on Zomato or Swiggy, what is the point in offering 100 rupees cash back to use a buy now pay later product? We need to ask these hard questions, right? And as an industry, I think what we will gravitate towards is asking those real hard questions to the operators, essentially, which are leaders like us, which are our product people, which are our business people, etc. Because see, it's what I have been hearing in the market, right? People are making some weird statements that after spending $100 million, they come back and say, oh, we have figured this segment makes so less money. How will I make revenue out of it? I think, spending 100 million to learn that, is a very sorry state. And if somebody would have come to my dear friend Anand or myself, we would have told that person that thing 5 years back as well. Right. So now the point is, that you need to solve a real pain point, and it may be hard to find. We need to do that hard work, legwork, solve that problem, and ecosystem will pay for it. I'll give you a very simple example. All of us today in the market, whenever we are making a payment, we hear this sound box, and it's not one company, multiple companies are now offering it. You would see in market people who are not even having a shop front, people who are a moving shop. They put their stuff on a bed sheet on the side of the road. I have seen them carry 1 or 2 such speaker phones for which they pay monthly rentals, etc. So the point is, it's this statement where you say, Indian SMEs or Indian consumers do not pay. I think this will not fly. People will pay, but you need to deliver value. You need to understand and solve for real pain points. And I think that is what the ecosystem will gravitate towards. There is a huge financial inclusion that we have to solve for. I think regulators' intention with a lot of things was that these newer investments will go towards solving that financial inclusion problem. But that has not happened. There is no point in solving for the top of the pyramid. There is no point in pushing people to pay through your platform for credit card bills, and then giving further cashbacks and points for that. So just to summarize, my point is we will gravitate towards doing some real problem solving, doing some real good work, which will have really good value creation in terms of financial inclusion, and also value creation for investors going forward.
Yeah, sure. So very realistic points, Karjo, and I really admire your thoughts, and thanks for putting it out. Because now of late, people started talking about the similarities or the resemblance between a couple of business models, or perhaps everybody's doing the same, and and rally shifted towards credit because they realize that payments में पैसे नहीं बन सकते हैं. But thanks for adding that point, Gurjot. So Anand, let me come back to you. And when we speak about solving the real problems, when we speak about building financial inclusion, Bharat, or the rural India comes in front, where you are operating very aggressively. What kinds of opportunities do you see for fintechs, perhaps who just focused on urban? and now should focus slightly towards rural India because perhaps the problems are more there. So how do you see that market, Anand?
So I will draw a distribution curve with 10% digital savvy greedy segment, over digitized, as Gurjot said, digitized to the core with net banking, credit card, 3 credit cards probably, and debit cards, and multiple pay apps, loyalty shifting depending on who's giving discount when. Yeah, so long live couple of them who were early movers and were rocket fuels, so to say, to burn out fast and finish the money.
Right.
Minus that 10% of India, there is 90% of Bharat, which is marginalized and subsidized, so to say. But the whole resolve that we at Payoneer took ab initio, right at the beginning, was to granularize, digitize,
Huh.
and universalize the high enough technology for the bottom of the pyramid. The same is good for the urban center and is required in the rural as well. The fact that credit, content, and commerce are three lifelines which is required even in the 90% of Bharat, as you and I need in the urban. The key challenge was the payment part, which is broken. And I will give you a perspective. I keep repeating it, Amol. You would be bored of it. That 6 lakh villages have only 32,000 bank branches. Yeah. 115 million debit cards, RuPay, were put out of system in November 19, just before the lockdown, because they were not chip and pin compliant. How will they go on to the UPI? When the MDR is zero, the banks have apprehension in recarding this segment. If they're not carded, how do they go to UPI? The fact that 525 million citizens have WhatsApp, a published number by Niti Aayog, only 280, 300 million users use UPI. What happened to the remaining? The mobile numbers are not updated in the bank. Now that line, it's a live wire connecting the Bharat and India. That wire needs to be connected. And while banks were not willing to recard, we took upon ourselves to rebank Bharat. And we went with a partner bank. In a very short span of time, we demonstrated a massive outcome of payment rails itself, and profitably. Yes, payment rails important, profitably. The consumers are willing to pay. This is the segment where the 90% of the citizens respect the service.
Right.
They are not the savvy greedy segment. They respect that someone has brought the services from high end to them. So starting from the payments which are viable for us, we process $1 billion a month, and it's a commendable outreach into the hinterlands. But having laid those railroads, we put commerce, content, and credit on top of it.
Right.
We recently launched a module called Sabkuch. Like you saw the ad of fog. क्या चल रहा है? Fog चल रहा है. Yeah, uh, Mr. Patel. We replicated the idea, saying at a retail outlet, क्या मिल रहा है? सब कुछ मिल रहा है. We have been able to integrate, consolidate with ONDC and lot more other modules. We backed a patent last year on digitizing and modernizing retail. So all of that powerhouse has been brought into a small kirana now. He sells football, he sells a refrigerator from Chroma, he sells a television or a Samsonite suitcase powered by Sabkuch. Now, with that commerce, credit is required. You bring in BNPL or you bring in a pure digital payment rails. So what was important for us from the inciting perspective was to bridge the payment rails first and then alongside build on these. Ultimately, Tasir common hai. The content watched by you and my friends in Khagadia, Bihar is same Netflix. The aspirations are similar. The requirements are similar. So don't treat the human beings, at least at this level, as different. They have different needs. Yes, when you go deeper down to women, to farmer, their need for insurance is very sachetized, very granularized. Likewise for loan varieties, the repayment cycles are very different. They cannot be cookie cuts of you take an online loan and pay in so many installments, because they don't have consistency of income. I can go on and on, Amol, so please stop me on Bharat, because that's the 90% of the segment that we are catering
Right.
to. And thank you for calling out to everyone. Please come and help my Bharat. Come and join hands. We don't treat you as competition. It's a co-option of the ecosystem. So please welcome, and we'll be happy to host you, anyone, the listeners who are watching us. Thank you, Amol.
Yeah. No, sure. I think quite meaningful, Anand, and the change is happening. Maybe not perhaps at the speed that we expect, but I visited a couple of villages, and the people who are looking for a branches or bank branch in their village are okay if there is no branch now, because they are happening, transactions are happening on the UPI. I think that's a interesting change that is happening there, and there is a huge market. So Vinay, let me come to you. And those who could not make money specifically into the wallets and payments, everyone shifted to the credit sides, thinking or assuming that they will make money. And we know what is happening with the credit story of India now. Specifically, a lot of fintechs are failing on that side. Obviously, you are a regulated entity and a very different entity. So when we speak about now fintechs who are working maybe as a LSDG, a loan aggregator, what is going wrong according to you with the fintech companies operating in a lending space? Because if we try to demystify what is going wrong, perhaps a couple of people will get a sense, how to get it right and what could be the next good strategy. So being a regulated entity, how do you look at the whole credit ecosystem built by fintechs now?
Yeah, so when we started Faircent, this was 2013. That time the word even fintech was not coined in India, in fact. So that's the time we started. And I come from the background of partnerships. I dealt with internet companies in the past, so I came with a background of alliances, right? So what I thought was that why is it that in the financial services alliances can't be made, right? So we went ahead and started doing alliances. In 2014 we did our first alliance with Anand Eco. Okay, so that from there on we did some 60 alliances. Okay, and these are large organization, technology organization that we are aligned with, onboarding their customers, journey onto us, and we as a lender trying to fund them, right? So the borrowers is brought in by them, and we fund them, right? But what we realized also was that, and later on everybody started, right? All of them started with alliances. They had partners on one side and money on the other side. All of that lending business started, right? From Zeiss, Slice, all of we gave to money to all of these guys as well, right? Right from Zeiss, Slice, Eco, all of them we gave money to also. But what we realized that and this realization came in after COVID, right? So it's a obviously it's a test that you have to kind of go through over a period of time to realize how this works. Most of these alliances, didn't, succeed, and primarily because, and rightly so, banks are not invested in this primarily because there was some inherent risk with these set of customers. And what we felt was that India per se, if you look at, majority of the customers don't have savings, right? And Subra will qualify that the number of customers who have savings and can invest is a very small percentage of India. A large portion of the India is people don't have savings. So something happens to their cash flow or their salary flow or whatever. If it stops, there is no way they can take the money out and kind of pay. Right? So you will see defaults coming in. You will see, but it does not mean that you don't get into this and try to kind of build that out. Right? So you have to do that. Right? Right. So what we've done is that we've left partnerships away. Right? And what we saw is that digital partnerships was a slightly riskier, primarily because you are exposing yourself a larger chunk of, let's say, to a Myntra or to a Eco or a MobiQuick or to these organizations. And when it goes, a large chunk goes, right? So what we did was that we went back to, the original DSA, network, which, used to work with banks and NBFCs a lot, donkey years, 20, 25 years. We started onboarding those guys, right? So today we have a network of DSAs, and we take individual risk on a particular borrower. And we also have a view on small loans, primarily because small loans are given out to people who typically do not have that savings or don't have regular flow of income coming their way. And banks have not got into this as yet. Large NBFCs and banks still not got into exposing their book. Even if they have a very small amount of exposure there. They have really not kind of got into. And fintechs like ours, or many of like ours, we exposed practically the entire book onto a model or partnerships like this, right? So I think that was a failure. I think going forward, I think it'll be a well calibrated, analytically driven approach with respect to fractionalizing the entire portfolio in such a level that your risk exposures are very limited, right? And I also feel that, as I said, credit is going to be a game changer, right? A lot of people talk about credit, about the engine, that they have a fantastic engine. We've seen this all along, right? So the 10 years is not a small journey, right? So when we started, we said, we were told that, every 7 years there is a cycle which comes and it destroys your book. That was told to us. And we were not from the financial services background. So we said, okay, 7 years is a pretty decent time. But when we got in, we saw the cycles, learned even faster than about 7 years. We had demonetization, then we had GST, we had NBFC collapse, and we had 3 waves of COVID, then we had
Right.
war and US recession, all of that, right? So today, anything which is happening globally impacts your credit, right? Or the way you're looking at customers to onboard. So not just evaluating the credit at that point in time of that particular customer, but also how this customer behaved in the past. Right? Similar kind of customer behaved in the past. It becomes very, very important. Right? So that data has to come, and that analytics has to kind of come through to kind of. So if you're going to launch a lending company tomorrow, it's not going to be as easy as to kind of at least if you're playing on Bharat, right? So if you're playing on the top, beam of the Bharat, then it's fine, right? Where the banks and NBFCs are exposing themselves unsecured loan. But otherwise, if you're exposing to Bharat, you have to be very clear about the data that you're looking at, performance data per se of similar lookalike customers. Only then it will work. Otherwise, not.
Okay. Thanks, Vinay. Absolutely. So, Subbu, you heard Vinay kind of pitching about how the credit segment can, be one of the important one if the data metrics are right. What I have seen is a lot of fintechs are entering into the wealth tech space and also insurtech space. You're operating in a wealth tech space. What kind of profitability that you think the wealth tech companies are making right now? Because a couple of them have shown profit compared to many other fintechs operating in different spaces. I think the wealth tech has become lucrative for many of the fintechs operating there. So how do you view that situation? Is it easy to make money? Is it easy to make wealth in the wealth tech business right now?
Well, I don't think it's easy to make money anywhere. Any regulated business and any business that has the large market opportunity will have competitors and regulators to make sure that money making is difficult. So I think any of these, it's first thing is it's not easy. I think wealth more so is quite competitive. We have established players, we have established financial institutions, banks, new age players. Within that, different flavors of players, stockbroking companies, wealth companies, retail wealth companies, HNI wealth companies. We have a plethora of market participants here who are, trying to solve various problems in the value chain. What's good for wealth tech industry is, the market is at such an early stage from an evolution perspective that there's just a massive headroom for growth. I think India is going through probably a 20-30 year trend of financialization of wealth, where people who have traditionally stored their money in gold, real estate, and bank deposits are finally moving that money to stocks and mutual funds and pension funds and so on and so forth. Right. So I think that to me is the trend started like 4-5 years ago, and that's going to continue for another 25 years. 25 years. Like, it's a multi-decade trend of financialization of wealth, and in spite of all the noise that we have seen, we have less than 3 crore people out there, about 3 crore people who are investing in capital markets. And that's pretty much it. We have like 30-40 crore people who buy on e-commerce and pay on UPI, right? So I think from a market growth perspective, this quite there's significant headroom, and this is something that will continue to happen over the next 5-7 years. I think market opportunity is for real. Frankly, for all fintech players, market opportunity is real. For example, in credit, when I spoke about it, 200 million people in India have access to credit, whereas 800 million people want credit, right? So it's like absolute scale and market opportunity, both are pretty strong for credit. Same thing for payments. Payments, you need pretty much everything that you need. Wealth, much smaller scale right now, but opportunity size is much bigger. We are regulated in terms of what TERs and commissions. It's much more regulated set of plans for some of the other areas. So the point I'm making is market opportunity is large. Compliance costs are high. Money making is not that easy. Yesterday, SEBI released a new consultation paper where there is a new TER framework that's coming up for where some of the AMCs will start making less money from the assets under management, so on and so forth. But I think what keeps everyone going is the large market opportunity and generally a fixed cost business. So there are two. The big cost in the business is cost of customer acquisition. So any business that spends lots and lots of money to acquire customers will struggle, and we've seen time and again. So the companies that are profitable are the ones that have very frugal way of acquiring customers. So one of the way we work at Fisdom is we work on a partnership model. We partner with banks to help their customers access wealth products. So we work with about 15 banks, and these banks customers use Fisdom for availing a variety of services, which includes mutual funds, stocks, pension funds, tax filing. In fact, we work with Pay Nearby as well.
Great.
We have partners as well. So their customers use the product. So ours is a consumer product. We invest in building a great product, but the distribution is largely through B2B2C, because the big cost in India for any company is customer acquisition. You talk to a credit company or you talk to an e-commerce company, everyone will tell you, look, acquiring high quality customers is expensive in India, right? So how do you keep that to a very, as controllable as possible? So our approach has been to take a B2B2C distribution approach, partnership led model, and that's working well for us. To your question, to sort of summary of your question, there are profit pools in the wealth business, but I think what's more exciting is just the sheer scope for product, market expansion and innovation. As I said, less than around 3 crore people access right now.
Okay. Okay. So Garjot, partnership, which Subbu mentioned, is one of the major aspects. You come from a platform background, in fact, but considering the challenges that is happening with a lot of fintech companies, they do not know whether they want to go ahead on their own, or they want to be they won't allow banks or financial institutions to acquire them, or have a strong collaboration or a partnership model. So that's the confusion that is happening right now. What is your view, being a platform? What model may work very significantly for a fintechs going forward?
Well, see, from a distribution standpoint, right? Digital or technology helps, in making the delivery efficient, right? And what one needs to understand is that the digital channels will max out, or they may reach out to the same top of the pyramid, as I had mentioned. We may have to go beyond that, right? So it is not, you may deliver with technology, you may deliver efficiently with technology, but a lot of distribution can still be offline, right? So from our standpoint, right, in India, we've gone live in the market sometime in December last year, and we already have 50,000 plus micro and small entrepreneurs on our platform. All have been onboarded through 100% digital journey, through a video KYC, full KYC, the RuPay card. All these 50,000 plus have a full KYC RuPay card in their hand. Now, having said that, we found that in India market, a good mix of partnerships and digital will work for distribution, and that is working real well for us, because if you need to go beyond tier 1, tier 2 cities, the way the sales cycle works there, you have to understand, somebody needs to talk, explain the product, handhold. So we need, our acquisition cost has to go into that as an investment, so that last leg of delivery and financial inclusion happens. So that's on the distribution side, right? On the product side, right, as a platform. So we firmly believe in in partnerships with the ecosystem. So there are products which we call tide label, there are products we call partner label, right? So a platform like us, what our thesis is that we will not be able to build everything ourselves. We do some things well ourselves, but wherever there are people who are serving small and micro entrepreneurs with a good product, we may work with them to bring them to our platform and deliver that fulfillment accordingly. See, what we need to look at from a market standpoint is that India is a large market. You look at any segment, right? Even if you look at micro and small entrepreneurs, you look at consumers, etc. Large market, huge under penetration, hugely underserved, right? And there will be there is always a place for many players to thrive and grow. It is not a market which is winner takes it all. It is not a market where a couple of players will take it all. There is space for multiple players to thrive, and hence in the ecosystem I believe there's a lot of scope to partner and work well. Now, having said that, what what has to be the basis of these partnerships. So now, from these partnership standpoint, what has become amply clear over last few years is that the partnerships which focused on compliance and regulation from day zero, I think those partnerships have thrived, right? The partnerships who at the center of it, had a play in some sort of gray area, they have suffered even when they have become too big, right? So
Right.
I think the mantra has to be that both the partners, the fintech, the technology, as well as the partner which is being regulated, they need to sit together and understand and solve regulation holistically. A fintech partner cannot say that regulation is headache of my regulated partner entity. Similarly, the regulator partner entity cannot just say that the customer is being handled directly by the fintech, right? So that's what has been clarified very well by the regulator. I think that's another amazing change that we are seeing. Regulator is clearing out each gray area that is coming to their attention. They are very clearly now stating things in black and white. I think from that standpoint, that's very important when you're starting a partnership.
Right, right, Karjot. So I will stop here with my questions. I will take some audience questions as well now, and please feel free to answer them. So Anand, I think the first question, I think you should take. This question is specifically about the payment. So the gentleman is asking, you know, considering the MDR charges are there and heavy competition in payments, uh, can fintechs make money? Those who are operating in payment space, can they be ever profitable?
See, there is a government enablement during the lockdown to help adopt digital payment. The MDR was nullified for a while, which Ministry of Electronics appreciates that there is a cost and there is a 25 basis point reimbursement that is being done. So very clearly, government does appreciate that it is it needs sustainable support. Having said that, there is a team at Payment Council of India which is working with the Finance Ministry, with the Government of India, trying to bring the MDR back. Ultimately, see, if you look at the US, the Dodd-Frank, when it was implemented, MDR was brought down to 20 bips, and the merchants revolted because the acquirer stopped giving services to the merchants. And the MCX revolted and said, why don't you please increase our cost and serve us better? We don't want India to go that path. Having said that, UPI has demonstrated a phenomenal growth. All the myriad transactions that have come onto this, the fact that today only a large funded company can only sustain and go into the markets without, needs to be considered by the government. If there is a need of innovation, if there is a genuine need for competition, if there is genuinely an intent to control that 30% embargo that was laid by NPCI, which is unfortunately or fortunately for now extended for a couple of more years. I don't think that is an implementable option. But the fact remains that to do any commerce, you need some money. Yeah, one could burn money and then earn, or one could keep earning gradually and then burn from there. The latter has been our model. We, frankly speaking, we have not remained uni mode, at least at Pay Nearby. People laughed at us initially that why are you doing four things? And we are happy to report that when MDR, the prepaid card were stopped from doing remittances, when MDR was reduced, when lending had its own challenges, people who were in monorail mode had the maximum challenges. But when you are on your four legs, one, you can raise and wave to say hi for a while. With regard to the regulation that Kojotpal highlighted, and I respect the regulator putting the people to the terms, because you have been given a license to drive a bike. You can't fly a plane, period. So if you are doing something which is out of your remit, you got to be limited controlled for a larger governance. And I respect the regulator because it came out asking regulatory review board, please tell us where are the flaws. The regulator was asking, where in the world has that happened ever? The Committee for Deepening of Digital Payment. Come on, the entire industry was sitting and giving inputs to Nandan and RBI, and it was brought out as a good program from there. So I think there is nothing about the gray and the black. The regulator also sees that there are certain things that are required to be done, and they will be done. And frankly, the innovation happens in the gray. If you keep white a white, a gray, Nandan keeps saying this, that innovation will lead regulation.
Yeah.
एंड फैक्ट यू विल कोरोबरेट ऐसा ही होगा और बस खाली हमें अपनी लिमिट के बीच में रहना है वी हैव टू रिमेन लिमिटेड टू आवर ओन रेंज
But the straightforward answer, Anand, is will they make money or not?
obviously every business is an opportunity to serve and need not be just in the India or Bharat. Everyone is willing to pay for a service. Unfortunately, people have spoiled them for choice. And the customer that you ask in an urban center about a new service, he would ask you, "Mujhe kya milega?" What? You are getting a service. You are getting an innovation.
Yeah, absolutely. In fact, Garjot
Imagine
mentioned
a
a
system
sound
building.
example. Yeah, that was a good one. Yes, because I think people are ready to pay if they really need that solution.
Absolutely. So we have reverse integrated into our app. We discourage our retailers to burn that $150 also. It is available for free. You really have to see that what are you adding value to and you are charging, because a telecom cost of $199 a month is unwarranted over there. And how long will a box provider continue to burn money? We work with the Ministry of Urban Development and the Mahua program for the Swanidhi vendors. The team there realized that it is important that we charge the merchant ultimately, and if he's willing to pay, but pay for the right thing. Well, look, all the best minds here, Tide, there is Fairsend, there is Fisdom, all of them. I'm sure there are IITs, IIMs, guys from amazing background. What are they putting their minds to? Not make money?
Right.
So, Amol, if I may just add here, right? So, see, it is always a mix, right? In payments, though there are certain products which have low MDR, very low MDR, and where the regulator is looking to, increase the market. So, if there had not been a UPI kind of a product and, a no MDR regime, the digital payment pie would not have grown to this level, right? But still, there are parts to payments where there is significant MDR. There are other significant opportunities to make money. So it is unfair to say. So for example, if it is a whole glass of milk, you need to have it completely. You cannot say, I'll just take away the cream and give me the creamy layer. So then that business will be very small. If you just want to focus on a niche, and there are people who are doing that. For example, MX, it is focusing on those merchants which are ready to pay a level of MDR and focusing on those customers who are ready to pay a sort of annual fee. Now the point is, as Anand said, you need to have wider set of services so that each gives some set of revenue, and you need to solve a wider set of use cases for a very large scale. That is only how you will be able to make a profitable business. So I think that's the key.
साहब दूध और क्रीम का तो पता नहीं, हम तो छाछ पे सरवाइव कर रहे हैं, शायद पानी. That's the wafer thin margin that we have in our business. Good, you brought it out. But yes, that's the divide. The cream is the urban centric youth, digital savvy self-service segment, and baki pani hum hai.
Yes. Noted your points, Anand. So another question is specifically about the credit, and if Vinay, you can take that. Why everybody is jumping on the credit segment, and fintech? Why most of the fintechs are jumping onto the credit segment? And do you see what could be the major reasons behind the fallout like Zest Money? So you can feel free to comment on Zest Money as well if you want, but the broad question is on the credit.
No, I think Zest is a fantastic business. It's just that they've been a little unfortunate about doing that deal. And the COVID hit them, and the losses stared at them pretty often. So I think I'll leave that part aside. But why is it that everybody jumping onto the credit? Is because credit is what has the largest margin, right? If you look at the entire financial services business, the maximum amount of money one could make is through credit. Even banks make it through credit. NBFCs make it through credit, and credit is a very old business. It's not a new business, right? Credit is as old as it's second oldest profession in the world. Credit started even before Christ. So the The model is proven. The model makes sense. You make money, and that's the only model which makes money also in the night for you, right? So it's 24 hours ka mein byaj lagta hai na? So it works for you in the morning also. It works during the night also. So that's the reason everybody is getting to kind of into credit. So look at it from this point of view. So when a borrower is given out a loan, you make a margin of 15% going up to maybe 24%. So that's the kind of margin you make if you pays back, obviously. So even if there is a default or whatever 5-6% default, you still end up making an average cost around 18-20%. You still end up making some 12-13%. So that kind of margin no other business would give you. Okay? Insurance would give you, but that's also just if you're into buying first time and also into non-insurance products, right? So otherwise core insurance products also not give you that kind of margin. So that's the reason I think people are wanting to gravitate towards lending, and that's how most of the partnerships get formed. But just adding to Anand's point, I think from making a money point of view is concerned, I think as long as there is innovation, knowledge, and vitality with large number of customers sticking, adopting, even the winter or whatever that you're talking about wanting, initially of the funding, it's not going to go away. It's still going to be in fashion.
Okay.
It's just that even if you're not profitable, okay, if you're sticking customers and there is a large adoption happening with customers, it's not going to go. Okay. It's very difficult to go. People are going to back. People are going to put money behind it. It's just that this situation today has come about. See, if there is a pressing need, I think the business that we guys are in, it has a large market. It has a pressing need, and also today, I think the investors are also looking at the background of people, experience of people. Now, they are a little kind of conservative about putting a lot of money with kids, right? So just pass out from college, a couple of years in college, and all that, and trying to start a startup. It started in US, I think, 10 years back. I think that story is now happening in India as well. So they are a little reluctant in putting money, people with background, with lesser experience and all that. And also, they all want to see the exit strategy. It could be acquisition, it could be making money, large amount of money in future. So all of that is I think a very clear direction. But I think lending per se, if you look at there is a lot of importance with respect to the past performance. What is the gross margin? What is the revenue growth? What is the monthly recurring revenue that you're getting? What is the net income? What is the churn rate? How many customers are dropping off? How many repeat customers are happening? What is the cost of a customer acquisition? And it's pretty straightforward. Okay. And after all that, what is the liquidity? So, for example, when we do, we kind of promise our lenders that we'll give you 12%. We onboard lend at 24%. Let's say. So we make a spread of 10%. If there is a 4-5% default, we still end up keeping some 5-6%. And plus, we make another processing fee of 3-4% from the borrowers. So you have a decent spread. And you make money, and that's the reason I think more and more people are wanting to gravitate towards lending.
Can I make a comment, Amul? Lending
sure.
is a business where you make money when the last EMI is paid. Yeah, till then you are counting the chickens before getting hatched, and I see mass India having reservation apprehension on borrowing money, and the second part is that you make more money on the people who default actually.
I might disagree to some extent. You can, but not necessary. So see, the kind of people that we are giving out money to eventually, not the ones which are locked in by the bank, right? So those guys, you'll very difficult for you to kind of give out money to. As you said, they don't need the money. But the ones you give out, may or may not the money come back, right? You're going to really go after them, right? Only then the money comes back. You have to get into settlement and all that to get the money. But otherwise, you'll not be staring at such a harsh, harsh default, which is the industry has seen the last couple of years.
Sure. So I think there are a couple of
credit card में बनता है, Anand sir, credit card में बनता है वो.
Yeah.
Good customer होता है, अच्छा customer होता है, ना?
Yeah.
Yes.
The defaulting one is the better customer.
Yeah, sure. So there are a couple of questions, but I think we kind of discussed them. So, and I think the time is also limited now. So let me shoot one question to all of you, and let me have your commentary or your observation on the current situation, and what could be the immediate repercussions of it. So, given the current situation, do you see consolidation will happen? Do you see M&As will happen? Do you see perhaps unicorn will become maybe unicorns again, or few of the companies will get out of the business because if they many of them are actually even failing to raise funds. So do you see the consolidation happening? And let me start with Gurjot quickly. I mean, maybe a few seconds to all of you. Gurjot, please go ahead.
See, well, it is very contextual. Depends on the company, depends on the investors and how that entire ecosystem looks like for that organization. But having said that, there are the wherever you see struggle, I believe the valuations those were being offered over last few years, at those valuations, the kind of money that has already been burnt to create the value which is available today, there will be challenges in having efficient consolidation. Because if you have burnt X million, right, and that X million was raised at a certain valuations, those valuations are definitely under pressure. So under such a circumstance, how will this consolidation story or the longevity story play? I think it is difficult to say. The organizations which do not have strong revenue models, what we can definitely say is there is definite period of struggle. The expectation or aspiration that this entire phase would be over in 6-9 months, I think that is not what is going to happen. This is a real change, a real long-term change, which will push the ecosystem towards creation of more value and sustainable businesses. And I would see challenges in a lot of consolidation happening.
Okay, sure. Subbu?
Yeah, look, I think the answer is yes. I think in my point, I think across segments there will be consolidation. There will be, pretty much everything that you mentioned. A number of business models needed. A lot of business models that have been started do require a lot of capital, and that's not in as much supply as it used to be 2 years ago. So when there is no capital, your companies end up going slow, and there'll be some founders, some companies, some investors who will decide, hey, listen, look, I will not run a zombie company than just mention. So I think that's a call, that some companies will take, some investors and founders. So my short answer is yes, Amon, there will be consolidation. There will be some companies that will get bought out and all of that. So
sure. Anand?
See, what did you say? The unicorns will become babycons? I did not get it. What was it? Amol, you said babycons.
Sunicons. I mean,
Unicorns.
will they? Yeah.
Okay, I thought babycons actually. That's where. See, the valuation is just.
I'm sure for Babycon they will take a long time, but at least Sunicon from Unicorn.
Yeah. So I think it's a overnight. You have the valuation of the company with a 5 billion to 2.6 billion overnight. It's just a matter of another someone valuing the company on a side. It's just in the numbers, I would say. Leaving that aside, on the consolidation partnerships, we have a NBFC on the table willing to work with us and actually sell off. There is a wealth tech company, there is an insure tech company willing to come and sell. All we are saying is, why are you shutting down? You have burned, as Goodwood said. Let me help you become profitable, because what we have is a DaaS framework, distribution as a service. I can integrate all of them and very easily take them to mass market. You have burned money, you have done your CAC, SHAC calculations and all, you have lost money at the end of it, but you have built a good tech. And we believe not in buying, but rather partnering with them, because in buying out, there are a lot of cultural challenges that with a burn mindset, someone coming on the table, I'm not a burn guy, but I can at least help them survive, revive in a pure business. So that's the kind of partnerships that at least we are working on. Someone said that we work with this company, the tax to when we help file returns, but would love to see if we could consolidate a system. Everyone wants to invest 10 rupee, 50 rupee, 100 rupee. Just because you and I are not able to take it to mass markets, Sahara and Shraddha did what they did. 2 lakh crore they could take out, scoop out from the same Bharat. Yeah, ultimately everyone has the same propensity to save and
Right.
invest. I think consolidation or not partnership, I would say I would remain confident on. And partners love it. With people whom we are telling, why are you shutting down? Why are you selling off? Because they would get sold up for a scrap actually. Because I won't use their tech, I won't use their team. I would just take the framework and apply it to our system. Much rather you sit there, run it, be my friend, be my partner, because you are the subject matter expert. हम तो दास ही काफी हैं. हम आपको डिस्ट्रीब्यूशन एज अ सर्विस देते रहेंगे. And it's a win-win, I think.
Sure. Vinay?
See, I think consolidation is something which will happen as we go along. You will see some of the larger players taking positions to have a bouquet of their services going for revenue. Buying into smaller companies. Right? So that phenomena have already started to happen. But and that would have anyways happened even if this funding crisis were. So that's a business which continues to kind of happen in the regular course as well. The valuation game, I think it's just a correction. I think it's going to come back because there was a frenzy of money which happened in India, and people were throwing money a whole lot. And so even I was not able to understand how this is being calculated. Right? So the math around this was a little beyond me. It was not on at least the transaction for sure. It was a number of customers. It was clearly not on transaction, and if it was not on money to be made. Right. So I think from that point of view, the future from a future point of view, I feel that large ecosystem players will, this is the time I think large ecosystem players will open up and come about, right, in the fintech space. In the next 10 years, this is how it's going to play out. If you look at any industry, if you look at any category of tech world, you will see that there are 4 or 5 players dominating it. Be it, let's say, shopping, be it recruitments, be it travel, be it for that any matter, right? So any category you look at, you have 4 or 5 people dominating the category. You can't name the 6th or 7th guy.
Right.
You will see that in fintech as well, right? Because customers at the end of the day will go to 5 or 7 of them, right? Will not go to many of them. So, for example, there is a large number of customers going to pay nearby, okay? But there is a small segment of customer going to fair and so large companies will look at to consolidate JB or whatever to have that muscle mass going, so that you're able to get them to serve much better. That's what my feeling is, and that's how it has happened. Globally also.
Sure.
Consolidation has happened. And there are some 5-6 ecosystem players which has come about, taking a large chunk. And I think India will also play out.
Yeah. Absolutely, Pratik. Absolutely, Vinay. Thanks for adding that. And thank you so much. I think we have to stop here because the time is already up. But thank you so much for sharing, I think, quite realistic perspectives here. Views were absolutely different, diverse views, but I think they were really important. And I'm sure the audience must have learned a lot from all of you. So Anand, Vinay, Subramaniam, Subbu to be a short form, and Gurjod, Gurjod, thank you so much for sharing your thoughts here and being part of ETBFSI's FinNext series. And thank you so much, ladies and gentlemen, for listening to us very patiently. Thank you.
Thank you.
Thanks.
Thanks, Amol.
Thank you. Thank you, everyone. Thank you.
Thank you.